Greetings traders and welcome back to another survival guide. Chris here bringing you some more information, and today that information is going to revolve around momentum trading. This is going to cover exactly what momentum trading is, how it came about, what the components of momentum trading are, as well as some of the most popular momentum trading indicators out there and some momentum trading strategies as well. But before we go any further, please click that like and subscribe button down below. It helps me out a great deal because it allows me to keep coming out with these videos for you guys. But without further ado, let's dive on into that material and learn about that momentum. Momentum trading has been and will continue to be a hot topic amongst traders for quite some time, as many traders, the elites on Wall Street to name a few, have used this and continue to use this on a daily basis, or at least incorporate some of the momentum trading indicators into their repertoire. But first, what is momentum trading? Momentum trading is a strategy that looks at the strength of recent price movements of a particular asset to determine the best time to buy or sell. The idea here is that if there is enough strength behind the price action, then it's likely to continue in that direction. So if the direction was bullish, then we expect bullish action to therefore continue. In physics, the term momentum simply refers to the quantity of motion of an object. The greater the force, the longer the object will be in motion until it encounters an equally strong force to counter it. It's a similar principle with momentum investing as well. If we were to say that the price of an asset starts to go up, and then we notice that more buyers are interested in entering the market, this then can cause the market price to go even higher. This momentum will likely go on until sellers start to enter the market, causing it to stall. Eventually, once the sellers outnumber the buyers, the price will generally drop and the momentum will change direction. As a momentum trader, our focus is on identifying assets with strong momentum and then taking the corresponding position to take advantage of the expected price movement. When the momentum starts to sputter out, we then close the position out and gather our profits. Momentum trading has been in existence for hundreds of years. As far back as the late 1700s, British classical economist David Ricardo was known to have used a series of trading strategies based on momentum investing to achieve great success in the markets. By 1937, the idea was formalized in academic studies and has since been used by notable traders including Jesse Livermore as well as Richard Dennis. However, it is the famous fund manager and investor Richard Driehaus who is credited with being the father of momentum trading. He believed that he could make more profit by buying a security at a rising price and selling it at an even higher price, in contrast to buying an underpriced asset and waiting for the market to turn. Today, momentum investing can be used in several markets, including the stock market, the commodities market, the futures market, and even the forex markets. There are three main components to consider when it comes to momentum trading. The first is volume. Volume simply refers to the quantity of a particular security that is traded over a given period. Keep in mind that this is not the same as the number of transactions, but how much of the asset was actually bought or sold. Volume is important to momentum trading because it tells the trader whether that asset has enough supply and demand, as well as whether it is easy or difficult to trade. Momentum traders go for high volume securities because it means the market is liquid, which allows them to quickly enter or exit the market as needed. So generally speaking, we want more volume while momentum trading. Number two is going to be volatility. Volatility is a measure of how much change occurs within a price movement over a given period. High volatility means the asset has experienced huge erratic price swings, which a momentum trader will typically favor. That's because momentum traders can take advantage of short-term price changes. That being said, a highly volatile market also means the price can swing the other direction and result in large losses as well. As such, it's always important to have a solid risk management system in place or use something like a stop loss. The third component is the time frame. The momentum trading strategies that are out there generally focus on the short term, especially since price movements usually don't maintain their direction for long in volatile markets. However, there are cases where the price action can sustain its trend in a particular direction for a longer period of time. The actual time frame does depend on the strength and duration of the momentum being measured. This makes momentum trading suitable for both short and long-term traders, but we do need to be aware of the time frame and the momentum as it applies to it when we are momentum trading. There are two main types of momentum that we should be aware of. The first is absolute. The second is relative. The prevailing difference between them is how they analyze the price action of an asset and its resulting momentum. Absolute momentum looks at the price performance of the asset compared to the past movements over a given period. It's basically comparing price momentum against its historical self. On the other hand, relative momentum compares the price performance of individual assets against the price movements of other assets within the same class. For example, let's say that the price of silver is going up and we want to buy some. We'd first look at the price action of other precious metals like gold and platinum to get a general idea of the overall asset class momentum as a category. So, how can momentum trading help us as traders? Well, when it's executed properly, momentum trading can help us identify profitable entry and exit locations. Momentum is a good way to evaluate price action since rising prices typically attract even more buyers, thereby pushing up the price farther. It's that self-fulfilling prophecy idea. Once you've confirmed the momentum, you can take an entry position and make a profit as long as the momentum continues. On the flip side, when the price does fall, sellers flock to the market, pushing the price even lower. Once we've confirmed with the trend that the momentum is indeed going downward, we can then exit the position and avoid incurring any extra losses that are anticipated as the market continues to drop. Momentum investing has become increasingly popular, especially with advancements in the financial technology that traders have access to nowadays. There are now smart trading algorithms that can quickly identify the strength of an asset's price movement and take an upward or downward position accordingly in just a matter of seconds. As more buyers or sellers jump in, the momentum intensifies. And that idea of that ever-rolling snowball is what we as momentum traders are looking to take advantage of. Because momentum trading is mostly concerned with monitoring price action, it's natural for traders to rely on technical analysis indicators to help confirm the momentum before taking a position. Here we have a list of some of the most popular momentum indicators out there that can allow us as traders gain some type of insight or some type of confirmation into the read of the current market or current asset's momentum that we are trying to gauge. The first is the moving average. This is probably the most popular indicator of all time just due to the fact that it's widely used by just about any style of trader. A moving average is used to identify the prevailing price trend of a traded asset over a particular period, whatever you have that period set to. It plots the price movements of a security in relation to its average price over a particular time frame. This helps us as momentum traders spot potential emerging trends. Moving averages are a lagging indicator, so that should be mentioned, meaning they're always going to be lagging slightly behind because they're averaging historical price together, but nonetheless, they are a wonderful source to help confirm a read on momentum. Then we have stochastics. Stochastics is another momentum indicator that evaluates the closing price of a security in relation to its price over a given period. The stochastics are used to identify whether the asset is overbought or oversold through a bounded range of values that range from 0 to 100. If the asset is deemed overbought, then it's usually due for a correction in the near future and the trader might sell. If the reverse were to hold true, then the trader might buy. Next, we have on-balance volume, otherwise known as OBV. On-balance volume measures buying and selling pressure in an attempt to predict price changes. It is represented on the chart as a line that tracks the daily volume over a given period. If the current volume closes above the volume of the previous day, it is considered positive. If it closes below that particular number, then it is considered negative. OBV is essential in momentum trading because it provides reliable feedback when trying to confirm the underlying trend. It allows these traders to potentially identify price changes as they happen. Then we have the Stochastic Momentum Index, otherwise known as the SMI, and we'll just underline all of it just to make it uniform, I suppose. So like other oscillators, the Stochastic Momentum Index measures the strength of a price movement to confirm a potential momentum behind the market move. The main difference is that the SMI uses a wider range of values and is more sensitive to the closing prices themselves. Rising closing prices that are above the median of the low or high price ranges signify that the market is bullish. Conversely, dropping closing prices below the median of the low-high price ranges indicate a market downtrend. This is what makes the SMI particularly useful in identifying momentum while investing. Then we have the MACD. This is also referred to, or it's more fully referred to as the moving average convergence divergence, but you'll almost never see that fully spelled out. The MACD comprises of two moving averages. There's the fast and slow exponential moving averages inside the MACD, and they're compared against what is called a signal line. The EMA lines converge, diverge, and overlap with each other on the chart, indicating the changes in momentum. In this way, the momentum trader can help identify market trends by paying attention to the interaction of these lines. Next, we have the ADI, which is the Average Directional Index. This tool is used to determine the direction and strength of a particular price trend. On a chart, the ADX can help show whether we should be entering or exiting the market, or whether we should even consider taking a trade just to begin with. This helps us make informed trading decisions, especially when used in conjunction with other momentum indicators. Next up, we have the Commodity Channel Index. The Commodity Channel Index is an oscillator, yet another oscillator on this list, and it compares the current price of the security to its average price over a given period of time. Momentum traders can use the CCI to compare price action over multiple periods in order to identify dominant market trends and make a more informed decision. And then finally, we have my personal favorite, the RSI, which is called the Relative Strength Index. The RSI measures the strength of recent price action and the speed at which they change to determine ideal entry and exit locations. As an oscillator tool, it also shows whether the security is currently overbought or oversold and is measured on a 0 through 100 scale. If the indicator is below 30, then it indicates the stock is oversold and will likely bounce back. This attracts buyers to the market, which in turn can fuel momentum. If it is above 70, then it might be deemed overbought, and there will likely be a sell-off in the next couple of trading sessions, depending on whatever periods we have measured. At the core of momentum trading, the idea is relatively simple. We're looking to cut our losses when the momentum stalls, or looking to jump into a position once we've identified that a particular security has strong momentum and continue riding in that direction. Some of the strategies that entail being good as a momentum trader include paying attention to things like looking for highs. When considering price momentum, if we look for securities with steady, consecutive closing highs over time, this can give us a good idea of which securities have sufficient momentum and are worth our time to invest in. As a momentum trader, it's usually pretty important to confirm that the market is not just closing at a new high, but instead consecutively closing at new highs. Then we can also focus on checking resistance levels. Securities that are testing their resistance levels are usually ideal for momentum trading, since they can intensify buying and selling pressure if they do break through that particular resistance. However, it is not enough that the asset breaks its resistance to just jump in alone by the rules of momentum trading. This is where our knowledge of technical momentum indicators will be useful to help confirm that the break is worth our time. And also, we have a watch list. Momentum traders typically have a watch list of securities that they monitor outside of the chart information that they're currently looking at. Political upheavals, health pandemics, and global unrest can significantly sway a market direction, so it's important to stay in the loop with current affairs, meaning whatever it is that we plan on momentum trading, we kind of want to pay attention to it on a daily basis as well. Then we finally have tame the herd. So generally speaking, being a successful trader means identifying the top and bottom of a market trend to enter or exit at the most profitable point. Well, this doesn't necessarily hold true for momentum trading. Instead, our focus is on being in the main body of the price action and letting that herd mentality and the fear of missing out of other market participants continue to push our position towards that profitable nature. The top three advantages of momentum trading, in my opinion, begin with the potential for high profit over a short period. If the security we are trading is backed by strong momentum, then we're generally expecting some strong, steady profits for the duration of that trend. Then, number two is the benefit of market volatility on momentum. Many traders stay away from volatile securities because of the risks involved, but that just leaves room for momentum traders to step in and make some profit due to those larger moves. And number three is that momentum trading allows us to benefit from the emotional decisions of other traders. The herd mentality can push that buying or selling pressure of a security that we're trading farther in the direction that we want, and we are looking to take advantage of this. That means all we have to do is pick our asset and wait for those emotionally involved traders to push the pace and just ride the wave. The potential disadvantages can be summed up in these two categories, in my opinion. We have that it can be quite time intensive. Being a successful momentum trader does require us to spend a lot of time monitoring the market, and sometimes this means studying charts every hour of the day in order to look for that ideal trade. So there is a time investment to momentum trading and being aware of the things like news, which brings us to number two. The sensitivity to news can be considered a downside for momentum trading. No trading method is without its risks. In momentum trading, the market is extra sensitive to external news, and a rising momentum can just as quickly start to go down due to a particular unexpected news release. So that can unfortunately hurt our momentum swings that we are already engaged in. So, in conclusion, momentum trading is another style of trading that can be extremely profitable and lucrative to a trader once they understand and practice it correctly. I personally do enjoy momentum trading because I like going with the flow of the market instead of feeling like I'm trying to stop a freight train or trying to catch a falling knife by buying the bottom perfectly or selling the top perfectly. It feels a lot easier in some sense to actually just go with the momentum of the market in general, but it is up to you to decide what type of trading style best suits you and to employ the correct practices if you do so engage on a momentum trading journey. But until next time, folks, please click that like and subscribe button down below so you can be notified the next time we come out with a video for you. I will see you all soon. Happy trading, everybody. Good luck and happy hunting.